Okay, let's get started, please. Okay, what I'd like to do today is to take the first half hour and kind of review some of the stuff that we did last lecture, just to make sure everybody's up to speed, because a lot of that was pretty fast and complicated. And I did put together a PowerPoint presentation that I've dumped on the iDrive under 453 that contains the slides that I'm about to put up. Okay? So I want to do two things before we start the case. And I see that groups are sitting with their assigned division. The first thing I want to talk about just briefly is how to use explanatory models in asset management. And then I want to review this idea of optimal attribute adjustment. Okay, so let me just talk through the using of explanatory models in terms of asset management. There's two different ways that these models can be used. Okay, the first way, you've got a factor model. Remember, it's explanatory. The return is going to be a function of contemporaneous values of many different factors. So the first way to use that is you forecast what you think the factor realization is going to be next period. It might be next year if it's an annual model, or next quarter, or next month. You've got some view as to what's going to happen. In a simple CAPM type of world, it might be that you think the market is going to go up over the next year. Then the strategy would be to use your knowledge of the betas to kind of tilt your portfolio towards securities that have a high sensitivity to the market. So this is a classic kind of market timing sort of strategy, where when the market's going up, you go into high beta stocks, and when you think the market's going down, you go into low or negative beta stocks. Okay, so it's a tilting strategy. It's based upon your view of what's going to happen in the future. Okay, and sometimes it's not even quantitative. That people take these macro bets based upon their feeling about a particular factor. We'll call it a factor. And they've got in their head some sort of view of individual sensitivities, asset sensitivities to these factors. Okay, so if you think that you can forecast the factor realizations, if you think you can forecast the change in interest rates, or the change in the market, or the change in foreign exchange rates, then you can implement an asset management strategy, a tactical type of model, based upon putting the factor sensitivities or the betas or the loadings together with your view of what's going to happen in the future. That's number one method. Number two method is different. It's you estimate the factor model, and it should explain a large amount of the returns. But there's an alpha. And basically what you're going to do is to try to use the alpha. Okay, let me explain in a little more detail. Suppose it's a simple factor model. You're regressing the particular asset return against, and let's work in excess returns. Excess returns against the one factor, and suppose that factor is the Morgan Stanley World Portfolio. And then suppose 1 month we get a realization of the World Portfolio excess return is up 6%. And you know that the beta for this particular asset you've looked at is pretty stable, and it's about 1. But you notice the security only went up by 4%. So it's the end of the month, the end of January 2001. The market goes up by 10%. Your security only goes up by 4%. But you're pretty confident that the beta is 1. Maybe you're off by a little bit, but it shouldn't make that much of a difference. So you've got an alpha here, and it's kind of a different type of alpha than you usually think of, because this alpha is kind of like a residual. It's kind of like what was expected based upon the beta of 1 is a 10% gain in the stock price, right? What was realized was only a 4% gain. So the actual minus the forecasted is the actual was 4%, forecasted was 10, minus 6%. Okay, so this is an alpha. It's a little different than what you usually think of, but it is an alpha. It changes every month. And the question is, what are you going to do with that alpha? And you've got alphas just like this for potentially thousands of different securities. So you've got a factor model that explains 98% of the variation with contemporaneous values. Right? And then all of a sudden, you've got this realization of something different than you forecast. Okay, and we're going to take it as a simple model where it's only one factor, just for illustration. So you have minus 6% here is your realized alpha. So what are you going to do with that? Does that mean that you would buy the security or sell the security?
Buy.
Buy. So I guess the logic here is that, well, you're confident that the beta is 1 or 0.9 or, you know, at 0.8 even, and you think that this security is going to catch up. Okay? So that's one interpretation of the alpha strategy. So basically, what you expect the next month is for this security to recover in value. Okay. Is there any other interpretation that might lead you to not do that? Yes?
Would you short the market if you bought the asset?
If you wanted to run a hedge strategy, you could do that. But really, what we're thinking of doing, don't consider this in the context of just one asset, because we're going to be doing this for thousands of assets, right? And we'll likely have a long portfolio and a short portfolio, and we're going to take the market out as a result. So you won't need to do that. Okay? We're just trying to identify good value here. But if you got this minus 6% alpha, the intuition is usually catch up. Is there any reason that you might hesitate in doing that? Yes?
That beta may have changed.
The beta might have changed, that's true. But it would be a pretty radical change for it to move from 1 to 0.4 in a month. Okay, but that's definite possibility that you need to keep into account. And I've purposely taken my example to be an extreme example. So it might be that the realization is 9% and the market was 10. And you're trying to think, well, has the beta actually gone down from 1 to 0.9? So this is a valid point, but given the extreme movement, it's probably not it. Yes?
The global market may come down.
The global market may come down. That's true. But if we're going to implement this with many securities long, many securities short, and kind of like that might average out. Okay? Yes?
The error term in your regression might change to that equals the return.
Okay. Okay. That's also true. Let me just kind of rewind a little bit. This point about the market going down next period, hopefully you see this, that if we just held that security, thinking, well, it's got to catch up to the market, if that was our only thing in our portfolio, that could be a disaster unless we hedge the market, right? So we would have to put on a hedge, some type of hedge position, right? But if we've got longs and shorts, then the way the market moves as a whole shouldn't really matter. Now the error term, yeah. Well, you're saying that there could be something happening in the error term. And indeed, this is what this minus 6% is. It's going to show up as a residual, right? So the question is, does this residual mean that we should buy the security, put it in the buy list, or put it in the sell list? Is there anything else you'd want to do? It's kind of important. Remember, we got a model that's helping us in our investment process. It's a simple model, especially the one I sketched with one factor. We've got a big minus 6% alpha. Does this mean we should buy the security? Yes?
Would you check company-specific info first?
Yeah, absolutely. It could be that there was some really bad news. You know, specific news to this firm that led people to revalue the stock. So there's got to be this other level of checking. So the minus 6% could just genuinely be company-specific bad news. It might be that you do the check and nothing's happened. Analyst forecasts are about the same. There wasn't much of a change in terms of their expected earnings. Nothing really unusual happened fundamentally, and that security is going in my buy list. You know, if they announced sharply lower earnings and laid off 3,000 employees, then I got to think twice about that. It's not clear it's going in the buy list, right? Because there's always this residual. So the question is, there's a residual. We need to kind of filter out of that residual the stuff that is specific to the firm and the stuff that might be due to misvaluation. Okay. Now, some people don't even do this check. They'll just use the alpha as it is. And they basically say that, well, given that I'm going to have hundreds of securities in my buy portfolio and hundreds in my sell, there's going to be company-specific stuff that I'm going to be able to diversify away. Okay? That's a possibility. But given the ease to which we can actually do these screens, and we're going to be talking about screening in great detail on Monday, it seems reasonable that you would want to use more than the simple alpha, that you want to do some company-specific checking on the error term. Okay? So those are kind of two ways to use explanatory models in kind of a prediction exercise. Okay? Now, before we get to the case, I want to go over this attribute adjustment. Okay, so now instead of using an explanatory model, we're going to talk about a prediction model in terms of the cross-section. Okay, and the model that we kind of introduced the other day was a model where you could think of having 1,000 securities at one point in time, and you regress on the lag values of some attributes for those securities. Okay, and it's a cross-sectional prediction exercise. Okay. It's across different firms. So you know, sometimes it's easiest to think about doing this in Excel, where in column A, you've got the returns of 1,000 different firms. And let's say those returns are observed in January 2001. Okay? So you've got 1,000 rows in column A. And in column B, you've got something like the price or the book to market ratio that's available in December 2000. And you've got 1,000 rows, and they're exactly matched. So if you go across row 1, it's IBM's return in January 2001, and go across row 1 to column B, it's the December 2000 book-to-market ratio for IBM. So all the firms are matched in the rows, and you just run a regression. And that's called cross-sectional prediction. And again, this is getting very close to, well, it's exactly what we're going to be doing in terms of stock selection. This is a method to select securities. Yes?
I just want to double check two things you mentioned in the last class. First of all, the book to market, you're just using that as like a proxy for the data?
No, I'm just using it as an attribute. I could use anything like the price to earnings ratio or the expected price to earnings, expected earnings divided by price. I could use momentum indicator, just any firm-specific attribute. This is pure prediction that I'm talking about right now. And there's lots of models out there just like this, where you take a large number of stock returns, regress them against attributes or characteristics of the firm that are available the previous month.
And the other thing is, if you're using one variable across different industries, does it matter that maybe one variable might mean different things?
Yes, it does.
Industries?
It does. And that's really what we talked about last time, and that's what I'm going to go over.
Okay.
So the book-to-market ratio could mean something different in the utility industry versus some other industry. Or it could mean something different across firms within a particular industry, and we need to worry about that. Okay, but the general idea is you've got these returns for many different firms. You regress them on lagged attributes. My example is always simple. It's like one variable in the regression. But firms that actually do this for a business, they'll have maybe 30 different variables. And you think, oh, well, 30 variables, that's a lot, you know, because I'm telling you to use maybe 3 or 4 in your regressions. Well, let's think about this a little carefully. In your regressions, you have like 200 observations, time series observations. So you're using 3 or 4 variables. These cross-sectional regressions, they could have 7,000 firms in these regressions. So you have lots of data. So you could use 30 variables. I don't actually recommend using 30, but you could. There's not much difference between using 30 variables for 7,000 observations and 3 variables for 700 observations. Okay, so you can put some stuff in, and often what they do is to drop in industry dummies. That's going to be important. But this is prediction, and it's prediction in a different way than you're kind of used to thinking about it. You're used to thinking of one series in time series, right? Going one period ahead like assignment number 3. What you're doing here is estimating across different securities. Okay. So let me kind of go through, I'll throw up some slides, and I want to go through kind of the math that we did last time and talk about this attribute adjustment, which I think is very useful. Yes, Igor?
I actually have a conceptual question, not related to this particular discussion. This method is based on the assumption that whatever coefficient you calculate, it's not going to change in time for the next step at least.
That's correct.
What's the intuition behind this? Why do we have reasons to believe that it's not going to change randomly in a very broad range for just the next month, or the next day for that matter, or the next year?
Right. And it's an issue for almost any prediction model, right? So your prediction model, the time series model, for what you were doing for assignment number 3, it could be that the coefficients change once you take it out of sample. Indeed, when we did assignment number 2 with the dividend yield, it appeared early in the sample there was a positive relation between dividend yield and expected return. Later in sample, a negative relation. Okay, so it's true for any prediction exercise that you need to think about the stability of coefficients. Okay, and this exercise, this cross-sectional prediction exercise, is a statistical exercise. Okay, we can use some theory to help us out a bit, and that's what we're going to do. But if you're just regressing on 30 variables, and the more kind of snooping the data that you do, and the more of the 7th lag type of variables that you drop in, the higher the chance those coefficients are going to be flipping all over the place and randomly changing. Okay, so the key to our success in actually implementing a strategy based upon cross-sectional prediction is the stability of these coefficients. They can move a little bit, but if they start flipping signs, then we're in real trouble. Okay, so just let me go through the process again, and then I want to jump into this case. So let's actually, this is what I'll call I'll call this a practitioner-like model, because there's lots of models out there that I know of that look like this. Cross-sectional prediction, just as I said, got January 2000, returns up on January 2000, regressed against book to market in December 2000. Estimate 2 coefficients, the D0 and the D1. Okay? And then let's use this to predict February 2001. Okay, these slides are on the iDrive, and webcast students, I emailed you the PDF file. Okay, so given that I know D0 and D1, and now I know the book to market January 2001, I plug this in and get predictions for February 2001. So I'm using my estimated coefficients, and I get predictions for February 2001. Sort the predictions, highest to lowest, and implement a long-short strategy. Buy the highest predicted returns, sell the lowest predicted returns. Okay, and again, you could have 29 additional variables here. The key is to get your forecast, sort the forecasts, and develop a buy list and a sell list. Okay, so it's a simple regression. Now, when you actually implement this, as I said last lecture, the problem is that the D1 could flip sign, could be very unstable through time. If it flips sign, it means that potentially your buy list should be your sell list and your sell list should be your buy list, and that's bad. Okay? One ad hoc solution is to average the D1 through time. So you're doing this every single month. Just take a moving average of the D1s. But that's not going to get rid of the problem. The other possible solution is to use our factor model methodology. Okay, so let's kind of go through how to implement that. And this is just the same stuff that I put up last time. You should have this in your notes. This is a simple factor model. Yes?
Just got one question on the previous buy and sell. If you have volatility in a certain equity in a certain security that's quite high, your data that you're using could be just part of that volatility, and you could get different signs depending on whichever day you use it. How do you take that into account when you run a model like this?
OK, I'm not sure I understand the question.
Volatility on a stock can change 4 or 5% in one day, the price of the stock.
That's correct.
And the model is selecting based on smaller, volatility or smaller range in price. How do you get rid of that, spurious or?
Yeah. Well, OK, I think I understand your question, but I might not. So let me try to answer what I think your question is. That we're using a large amount of data here. So there's going to be stuff going on. There's going to be a lot of error in individual security returns, a lot of noise. But given that we've got a large number of securities, that's going to somehow average out. And you're going to get like one security with some positive noise, another security with some negative noise. And we hope that we can reliably estimate the D0 and the D1. That's our hope. OK? And also, when we implement this with 100 long, 100 short, we also have some diversification there. It's not just like one long and one short, which would be a very dangerous strategy. Okay, so we're getting diversification. And indeed, it's a little more complicated than buying the first 100 and selling the bottom 100, because we want to make sure we're exactly market neutral. But we could do that with an overlay of the S&P 500 futures or whatever market we're in. OK. So this is the factor model with one factor. Make the assumption that the beta is going to be a function of the price to book ratio, or the book to market ratio. Actually, the notation changes a little bit. OK, substitute the beta in. And this is exactly what we did last time. We're regressing on the market. And then the market interacted with the lagged price to book. OK? Here we get like two betas, the C0, the C1. This is a time series regression for an individual firm. OK? The key insight here that I mentioned last time is that if we compare this to our original regression, the C1 FT looks a lot like the D1. Remember that we're regressing returns cross-sectionally on the lagged book-to-market ratio. And this is what I said. There's a reason that this cross-sectional coefficient changes through time, because this has got a T subscript on it. And also, there's a more serious specification problem in that the coefficient should be firm-specific. And this gets to the intuition that book-to-markets could differ across industry, across firms, depending upon the characteristics. So there is a simple way to adjust the attributes. And basically, what we're going to do is firm by firm. So we had 1,000 firms. We're going to run 1,000 time series regressions over 5 years, let's say, and estimate the usual beta and the C1 coefficient. So run this 1,000 times and collect the C1s for every single firm. And then what we're going to do is to scale each firm's book-to-market ratio by the estimated C1 and call that book-to-market star. Okay? So I've got 1,000 different C1s. I got 1,000 different book-to-markets. Create a new variable. Think about the regression in Excel that I mentioned, that we've got the January 2001 returns for 1,000 firms in column A. In column B, we've got the price-to-book ratio in December 2000. In column C, we've got C1 for every single firm. Create a column D, which is column B multiplied by column C. Run the regression again, our cross-sectional regression, and regress column A on column D. And all we've done is to rescale firm specifically the book-to-market ratio. This is going to be a lot more stable and better specified. And my research suggests that this is the way to actually use attributes in cross-sectional prediction. This is not something that's also that well known. There's some firms that are implementing this, but a lot of firms haven't figured it out yet. The main reason, I think, is that I published this result in not a mainstream finance journal, a European journal. So no surprise, the asset management firms, mainly out of the UK, have implemented this. Okay, so this is a way to get around the problem. And indeed, it's a way to get around a more complex problem, and that has to do with comparing attributes across countries, maybe different accounting systems, stuff like that. Well, you can use the same kind of methodology to put everything on the same footing. So remember what we're doing here. We've got a common coefficient, and D1 is the common coefficient that is telling us what the response of the return should be to the attribute. And it's the same across every single firm in the country or the world. Okay, so that's a pretty big assumption. So to take country or industry or firm-specific information, what we should do is, instead of running a regression that's impossible with 1,000 variables and 1,000 data points, we can't do that. What we can do is pre-scale the attributes. Okay, to put everything on the right footing, on the same footing. Yes?
I think we now have two models. The first one is the time series prediction model, and second one is the cross-sectional attribute model. And I assume that both models can be used to predict individual stock return. So two models, what's the relationship between them?
Good question.
Are they just two different approaches or methods, or they should be combined, or should be applied to different situations?
Yeah, it's a great question. We've got time series prediction model. We've done that in assignment number 2. You're doing it and assignment number 3. Now I've introduced a cross-sectional prediction that we're talking about today, and we're going to go into much more detail on Monday and Thursday. How do they relate to each other? Well, one key piece of information is, notice that your time series models are applied to portfolios. So you're forecasting the UK return or the US return. How easy do you think it would be to apply the time series model to an individual stock return? It's going to be difficult because there's a lot of volatility, as you said, in the individual stock return. When we go to a portfolio, we can diversify away some of that firm-specific volatility. Okay, so the time series models are almost always applied to aggregates. So sector portfolios, portfolios sorted by some attribute. So if we want to do book to market, we would sort the data by book to market and say, well, this is the lowest book to market quintile. Let's forecast that portfolio. But to actually apply this to individual securities is much more problematic. So the way it usually works is the time series prediction is going on for the aggregates. The cross-sectional prediction is using all the individual securities. Okay? Yes?
And you were saying the cross-sectional approach when you're covering all those different securities across different industries, there's a balance there. But if you're looking at one particular, can you apply it to one particular industry? Would it have more predictive power because the coefficient, because the book to market wouldn't be fluctuating as much?
That's a possibility. And again, the scaling is going to help. Somebody after last lecture said, well, the scaling coefficient, C1, that could change their time. It's true. So there could be instability even there. But I don't want to introduce a third level of dynamics here.
And I guess if you're looking at 1,000 securities over 5 years, you're going to have survivorship bias?
It could be, yes. We have to be careful about that. And that's kind of a common thing that we need to be careful about in terms of our backtesting of models, especially with individual securities. The cross-sectional regression that I'm talking about should be okay because it's like 1 month against the last month, right? And firms can drop in and drop out. And all we're really after is the D0 and the D1. Okay. The new securities could come in. So let's say I've got the universe, which is 1,000. We know it's larger, but suppose it's 1,000. And I estimate the D1 and the D0. And then when I actually go to use this to predict February, I notice that some new securities have come into the market. Well, I can just use the D1 and the D0. Right? So that's really out of sample. Give me their book to market, and even though they haven't even started to trade yet, let's say, I can predict the return in February. Now, I'm not suggesting you should actually do that because IPO return in the first month, you probably wouldn't want to predict with this cross-sectional model. Okay. So is that kind of clear? It's a little complicated. That PDF is on the iDrive if you want to look at it. But it's kind of important. The most difficult thing in this course is to keep straight the different models. So we've got a time series prediction model. We've got a time series model that explains. It's possible to use the explanatory model to predict. And I talked about 2 different ways to do that. We've got a cross-sectional model that explains. We've got a cross-sectional model that predicts. You need to keep all these models straight. And it takes a while because the most difficult thing I've found is the cross-sectional part. You kind of understand the time series. You've got hands-on time series stuff in assignment 2 and 3. But the cross-sectional is a little different than what you usually think about. OK. Can we jump to the case? Any other questions? OK, so what I'll do is I'll introduce this case. I do have a few slides here that kind of provide the setting. I'm going to be calling upon different functional areas. As I said, this is a case that I moderated at Shadow Whistler. That's where I was. For a very interesting group of people. They were some of the best clients of Lehman Brothers. So mainly fixed income, but some of them did equities also. So PIMCO, BlackRock, firms like that, big asset managers. We're all sitting around discussing this case. Okay, and I've got to admit that it was a very interesting dynamic because some of the people didn't contribute that much. And I found out later that the reason probably was that this case was kind of reminding them maybe a little too closely of their own firm situation. Okay, and I've also done this in another setting for another firm. And I found that it's pretty useful. So let me kind of go through the basics of the case, a few slides. Dream Team Asset Management is meeting to map out a strategy. They've got a goal here to go from 97 billion under management to 300 billion by 2005. So an aggressive goal. And they're owned by, and there's not much information about their owner. I'll call them CUB, Colossus. Is it Colossus Universal Bank? Something like that. And we know that they demand a 15% cash return. And given that Dream Team has already factored in a decrease in fees, they need to grow by 25% a year. And then it's kind of interesting, it's right, is it the CIO that says at the end? Where's CIO? Yeah, CIO says at the end, you have to wait to the end of the case to get this, that they need to deliver or they're fired. Okay? And it's kind of like, for me, that's a pretty significant constraint that they face. We know it's an aggressive goal, but it's real clear that they're all going to be fired if they don't deliver. But you have to wait to the end of the case to figure that out. Everybody seems amazingly friendly and calm in this case. So one thing that we need to figure is that Dream Team is like not the only asset management group meeting doing the same thing. You can assume that all of these other groups, whatever, I just made up some names like Big Alpha, Mammoth Alpha, First Alpha, Asset Management, they're all like, everybody's meeting all over the place trying to figure out what to do. Okay, so this is not in isolation. So we need to think about this in terms of a competitive strategy. And I gave you a few tips as to how to think about the framework for discussion. And as I said, this is a strategy case. Okay, so we're going to be talking strategy, which I've got to admit that this is the first time in all the years I've taught this course that we'll be talking about strategy. You've all done the strategy course, right? Yes? Okay, and I know there's some competitive analysis in it. So this is what this is about. Okay? There's a lot of detail in the case about performance, blah, blah, blah. That's relevant, but the key thing is how do we develop a strategy? The CEO's letter is real clear on this. So at the corporate level, they've got this growth target of 25%, which means they need to at least be matching the best firm, okay, to get 25% growth. And the sort of questions that I asked you at the corporate level would be, what will the winning firm look like in the asset management landscape? What are the strengths? Are the strengths sustainable? What are the vulnerabilities? And we're going to wait to the end to talk about are they actually going to win? And I told you to do some other stuff on the functional level. And in some of the points that I think are potentially interesting are, should there be commonality enforced across the firm? Or should there be diversity? And then this kind of feeds into the asset allocation choice within the firm. Is it clear, like Asia really makes the case that that's where they should tilt. Well, you know, what are the other functional areas to actually think about that? And another thing that I'd be interested in talking about is the organizational structure. Is that going to be a plus or a minus? And are there any suggestions actually on this? So, so let's kind of start the discussion, and maybe for the first 20 minutes before we take a break, talk about some corporate level topics. And after the break, I'm going to be going group by group, and I expect an assessment of the functional level strategies. Okay, so let's talk about the corporate level strategy a little bit, and what about things like the landscape? We talked about the landscape a little bit in the second lecture. The competitive landscape. Like rule 1 in doing strategy is some competitive analysis. What does this industry look like? Maybe the group that had the best perspective on this would be the CIO. The CIO is actually the only person in the case that actually does some visionary thinking. So what about the CIO?
Well, one aspect is the markets are becoming more global. So there are becoming a wider variety of instruments and indices overall across all countries. to some extent, which makes it a little bit harder to find appropriate benchmarks. But okay, stepping down a little bit. Again, on the macro level, more global.
It's more global. And what about this firm? This firm's in a global position, right? Is that
Yes,
good?
But
Well, the firm isn't in a global position. It has offices on 4 continents, and we perceive that as potentially a strength of the firm. But is it a competitive advantage? No. I mean, if you're going against other global firms, everybody's going to be globally diverse. Excuse me. However, the CIO does feel that the firm has significant opportunities based on changing demographics within certain areas. So he mentioned specifically the baby boomers. He says as baby boomers start to retire, they're going to be more interested in fixed income type of investments, and he sees an opportunity there.
Okay, let's just stop right there. That to me seems like a very U.S.-centric view.
It is, and that's why I said he sees opportunities in specific regions. That really that may not be able to tie into a global strategy. It's kind of the CEO's job to coalesce all of this together and take the input from all the regional managers and develop a global strategy, just as you talked about. But he did key in on certain regional specific predictions like that.
Okay, so let's go with the U.S. The U.S. There's going to be a baby boom. Suppose that means people. Well, there has been a baby boom, and these people, instead of being heavy into equity, they're going to be in fixed income, and that's good because they're a fixed income manager. What does that say about the competitive position of this firm? That's just a fact. It's a demographic fact.
Exactly. And once again, that's not necessarily a competitive advantage for this firm because presumably if it's going to benefit the dream team, it's going to benefit the competitors as well. I utterly agree. So far we haven't latched on to a global competitive advantage of the firm. One thing that comes up again and again throughout the case are the overall worldwide marketing, research, and technology strengths of the firm. At least from the CIO perspective, he feels that they're very strong in those 3 areas, yet they need to grow as well to meet the upcoming demands. So you could potentially, without knowing too much about the competition, think that could be an advantage that you have to work hard to sustain, but it could be an advantage.
Yeah, but we know the competition, right? Like in this case, it's pretty simple to figure out who the competition is for this firm. This is a created firm, right? Dream Team Asset Management, but we kind of know who's out there in general. And even if you don't know the players, you know the basics, right? That they're a strong global presence. And basically, Dream Team wants to move from 97 to 300 to be like one of these big players, right? So it's going big.
Right.
So one issue that struck me is that the way to go? So do they have a chance of competing against the players that have got $1 trillion, that have got not 4 international offices, but 25 international offices? Yes.
And they currently don't have the scope. They're active managers primarily, and in order to grow to that scale, they're going to have to venture into more passive approaches and blended approaches like enhanced indexing as well. And essentially a lot of their styles, even though they're active, they're somewhat conservative. They haven't reached out so much for trying out new styles and new models for the most part. And that's where they should focus more so as opposed to just thinking about the raw asset number. And it's likely the way they can get to that asset level is through acquisitions, but strategic acquisitions in areas where they're not as strong. For example, they haven't been very good in currency hedging or prediction. Hence, that may be, if they want to grow in size, an area where they acquire. If they don't want to grow in size, then maybe they don't focus on that as much.
Right. What is the area that, I forget the functional group that said that the only way that we could achieve this is with acquisition. Was it Americas?
I think the Americas.
Americas. So the Americas is more pessimistic about this. So basically, we've got, and just because I'm calling Americas and CIO doesn't mean that anybody can't contribute here. Like, I'm going to specifically call upon certain groups, but anybody can jump into this because we're talking corporate level right now. Okay, and one issue is, okay, we kind of know the demographics, that's the same for everybody. They're trying to be big, but do they have a competitive advantage in doing that? Or is there another strategy where they could be a niche player? Okay, and there's also this issue of how to grow. So a lot of their growth in the past, how'd that happen?
Acquisition.
What acquisition?
Lost.
Yeah, CUB bought them and then doled out their asset management part to Dream Team. Okay, but now they're thinking of like additional acquisition, and there's an issue here. What are we maximizing? What do we want to maximize here? Yes.
They want to reach a 15% growth objective. It means that either they need to manage more assets or charge a higher fee for the asset that they manage. It is certainly the case that if they manage a dynamic way, it can justify higher fees. And so therefore, they need to find a solution to dynamically manage the portfolio, have higher return, and therefore charge more fees.
Right. So it seems that charging higher fees is going to be difficult. And Econ's going to have something to say about this after the break, because I definitely want to talk about the hedge fund strategy that comes from Econ. So there's a way to charge higher fees, right? But aside from that, there's a lot of pressure, and they realize there's a lot of pressure on fees, right? So the question is, there's a possibility of getting some new money in at lower fees, but what about acquisition? Does that necessarily, increase value? Like, what's going on here? Like, that's the key thing. They've got this target of 25% growth. In the background, we've got this 15% rate of return. Yes?
Well, I think the focus of the Dream Team has been very much internal. They weren't thinking out of the box at what their competitors are doing, how the industry is evolving, what other people are doing. All they were actually thinking about is how can we go from point A to point B, and not considering anything else that's happening with respect to their competitors. For example, if you look at the asset management industry, companies have been being bought out for extraordinary prices. So one thing they could do is just get bought out, and maybe that's better value for them.
Well, they already got bought out by CUB.
Well,
you mean CUB could dump them?
Yeah.
It's hard to justify the meeting at Shadow Whistler to talk about that. Right? That's really CUB's business, right?
Yeah.
So CUB's giving them a target, and they have to kind of deliver to the target, right?
Yeah.
Or they're fired. If they went to CUB and said, well, why don't you just sell us? Yeah, I don't think that would work. They'd be dumped faster than, or fired faster at least. So yeah, but I agree with what you're saying. It's kind of point A to point B. CEO, what's the story? Why? The CEO gave direction to each of the functional areas. Part of the direction involved competitive analysis. No.
Really mentioned.
Well, that's surprising, isn't it? Now, we all taken Strategy 101. Actually, I took your Strategy 101 because I was on the strategy committee for the school. And I figured I needed to know at least what you're taught, right? So I went through the books and the notes, and it's a lot of it is economics based, and kind of number one thing is competitive analysis. Got to know that, right? How can you develop a strategy without knowing the competition? Okay, so one thing that just jumps at you like crazy in this case, it's not a short case either, right? 47 pages or so. There's no competitive analysis in a strategy case. Okay, well, we can, give them the benefit of the doubt. Maybe they're doing it in their head, the strategy. But let's talk about kind of this competitive situation where they've got a choice between being big and maybe being a niche player. What do you think they should do? Is it obvious to you that the way to add value is to be big? No? Okay, why would you be big? Because that's what they've chosen to do. So a lot of this kind of reverse engineering, what they're thinking. Yes?
Global access to investments.
Okay.
Further reach.
Okay, that's what you get as a result of being big, right? And somehow that enhances their product offering and will help their position.
Yeah, you assume that with more products, they'd have a bit more synergy between products and therefore be able to charge higher fees.
More products, more synergy between products. That's interesting. I want to return to that point of synergy between products, and I want to return to the point of synergy between functional areas. Yes?
I think everyone wants to be big because it's a business with tremendous operating leverage and economies of scale, so that costs definitely don't go up by twice as much if you double your assets under management.
Mm-hmm.
So everyone's really striving for that size.
Okay, so that could be true, but what happens if fees start to decrease? And given that you've already got these large firms out there that are really good, much larger scale, they've got advantage over you on a global basis.
I'm not saying that that's a proper rationale. I'm just saying that's the reason why everybody in this business, no one believes necessarily that fees are going to decrease at a rate proportional to
Mm-hmm.
what the increase in asset management would do to revenue. So.
Okay. But I guess we're sitting at kind of like an academic environment, and we're going to second guess these people. Okay. So I guess from my perspective, there needs to be additional analysis. I've seen a situation. I've been in front of a group about this size, except can't reveal the name. Large international asset management / bank kind of situation. And basically the goal, as stated by the CEO, was maximize market cap. So a series of acquisitions to maximize global market cap. Okay. What's the problem with global maximizing market cap? We're all taught, the stuff in basic finance as to what you should be maximizing. Yes?
You want to maximize profit, not necessarily the market.
Well, profit's going to increase as you acquire, assuming the things you're acquiring have profit, then you would think the profitability would go up.
If you expand your asset base and you keep growing and growing it, and you keep adding infrastructure, and the infrastructure, let's say in one country is talking to another country, and you're having to see.
Yeah, but you're just picking up the stuff, putting it into kind of a conglomerate even. We assume no synergy whatsoever. You buy this, you buy that, profits are increasing, market capitalization absolutely increases. Right? Is that what we should be doing?
Would you then be subject to, you won't be able to choose your assets anymore, and basically your returns may start decreasing as a result?
The returns might start to decrease. But I understand why.
Well, more the investment size you have, the larger your presence in the market.
Yes. Okay, so you could be interfering with what you're actually doing. Yeah, maybe kind of the analogy is the $5 billion hedge fund trying to trade on the S&P 500 futures. The size of the order is so large that they're going to move the price. It's another way of thinking of this interference. There's something more fundamental here.
Well, I don't know if this is where you're getting at, but the problem that I see with a strategy that is based on size or on market cap, if you will, is not sustainable. You reach a point where you just reach a natural limitation of It's not a long-term.
That could be. That could be. There's something like really more fundamental here, and it's actually meant to be like obvious. Sorry. Yeah.
Maximizing market cap is not the same as maximizing shareholder value.
Exactly. Okay, so you can think of maximizing market cap by buying negative NPV projects. Okay, it's going to increase your market capitalization, but it could destroy shareholder value. Okay, just think of it. You're a shareholder, right? You overpay for some asset, right? That's going to decrease your shareholder value. The actual capitalization, which is the share price multiplied by the number of shares, could increase, but this is not necessarily value enhancing. Indeed, this firm I was talking to, they were scratching their heads because they didn't understand why, when you looked at all of the individual parts of their organization and did a valuation, that the individual parts were worth much more than the whole. And it was simple, for the way I looked at it. They were overpaying for these acquisitions, and as a result, stock price, decreased. Okay, so the key thing is you're going to acquire, you have to make sure that there's a positive net present value in actually acquiring. Okay, and one thing in this case that's a little strange is they're really talking growth. There's one mention of this 15% return, though it was kind of like not clear to me exactly how that 15% return was being calculated. Is that the initial price that they paid for Dream Team? How would you handle debt? And it was very unclear. It just seemed like everything was focused in this case on maximizing the asset base. Okay, and which is fine if you're growing internally, new clients. There's a huge advantage to the scale, as has been mentioned. That's a good thing because if you double your assets under management by getting new clients, and it's unlikely the fees are going to decrease by 50%, you don't need as much infrastructure. You don't need to double your infrastructure. There's lots of economies of scale. But as soon as you start going out and acquiring firms, you have to be real careful. Okay, you can have an acquisition that's got a 0 net present value. Okay, and it will increase your size, but will not affect shareholder value. Now, you might say, well, if we've got this acquisition, even though it's 0 net present value, there could be some synergy between this unit and what I've got internally. And that's just another way of saying that it's not a 0 net present value acquisition. It's a positive NPV acquisition. Because all of these synergies need to be taken into account. And if you're getting something what appears to be a 0 net present value in a different part of the world or a different product line supposed to help you, then that needs to be taken into account. But just to overpay for some money under management, that will increase your overall assets under management, but not necessarily increase value. Okay. That's the other thing that I thought was strange in this case, that there wasn't much explicit discussion of that. Okay, so kind of where we're at the corporate level, before we take our break, is we've got a firm that has got an incredibly aggressive goal. More seriously, it doesn't seem as if there's an understanding of value and the goal. Okay, it doesn't seem like there's a clear understanding that internal growth, that could be very valuable, but via acquisition, it's not clear. There's also a lack of competitive analysis, an alarming lack of competitive analysis. Okay. And this maybe we can blame the CEO for, but if any of you got direction from the CEO like you got in this case, I would expect, even though it wasn't asked for, to deliver some competitive analysis. So that's going to be a critique of all of the groups. Okay. And the other thing that's not real clear, other than the CIO's general discussion of the future of currencies and stuff like that, it's not clear that they've kind of thought through what they really want to be in the future and what their real strengths are that are sustainable to get them there. That's kind of a good place to kind of leave off, because when we get back from the break, I want to go through and I want each group to be talking about the strengths and the vulnerabilities of the functional areas, and then we'll try to piece this all together. Okay, this case is an interesting case because it appears, if you look at the performance of Dream Team, it's been pretty good. Okay, as a matter of fact, it's been very good. And if there's a strength that at the corporate level I want to mention, like initially, it's that their performance has been good. And that's a strength that can be used to leverage future growth. So they've got that. But the key thing is not their past performance, but what's going to happen in the future. And there's that one graph in the case where you add a few months to their performance, and the performance degrades significantly. Okay, so when we get back from the break, I want to go group by group and to figure out what's going on in 15 minutes.
How was it?
It's not very spicy. It's not very greasy. They use a lot of yellow peppers. We don't. They like fresh things like that. It says.
So let's get started.
No, Brian is good.
Okay, the first thing that I would like to do is to score the groups. We'll have an initial score, and then we're going to kind of return to this. I asked you to do this scoring between 0 and 10, 10 being good, and 0 being like really bad. So I'm interested in the ranking, and let's go by group. Asia, how did you rate your functional managers? 7. Europe? 6. America's 1. America's 2. 6. Quant? 2.
I register my disagreement.
2 with some disagreement. Star. Econ? 5. Marketing?
4.
4. Okay. CIO? 7. CEO? 4. Okay, interesting. Okay, so basically I want to go through these areas, and then I want to return to these scores, and maybe we'll have a revote. Actually, maybe what we'll do is have other people vote as to whether they think it's high or low, and then I get my own vote. Okay. So let's start with Asia. I want to know what the key issues are for Asia. Asia, the manager got the second highest rating, 7. Strengths, weaknesses?
Well, we kind of try to outline the major strengths and weaknesses first, and then working from there, come up with whether the assessment of these things are realistic or not.
Okay.
We thought that there are basically 3 major strengths that the Dream Team has in Asia. First of all, they have a superior technology compared to small regional players in Asia in particular.
Okay.
And they have certain experience and expertise in creating products in bond indices in particular. Weaknesses, they only have $10 billion in assets, which is not a lot compared to the rest of the competition in that particular region. And Dream Team is still a small player in this market. We were not sure if their performance that they achieved for the last few years could be sustainable in the future. Based on that, we think that Kizo, the manager for Asia, he has a clear picture of what's going on in the region. He has a clear picture of what the strengths and weaknesses of the Dream Team is in this particular region. We were a little bit concerned with his obsession with Asia. He was a little bit over optimistic about the future performance, and he didn't pay enough attention, in our opinion, to some geopolitical risks in the region, and that's why we have subtracted 3 points. Is great, but we thought that 7 would be fair estimate for his position.
Okay, so let me review a few things, and maybe I missed some of the stuff. So the key strength that you mentioned was a superior technology
in that particular region, and we also, well,
what does that mean?
That means that the Dream Team has a certain expertise, and they have the technology already in place that enables them to collect the most recent data. It's not just about data collection; it's about data processing too.
Yes.
And that's even more important, given that.
Okay. Do you believe that strength is any different than some of the even larger players that are already in Asia? And do you believe that that's the type of strength you want to bet the firm on?
Well, we didn't have the information for the competition, as we said.
Yes.
So we only could base our judgment on the information provided for this particular team. And again, based on the case, we learned that they have advanced technology already in place, and they're not just having that technology; they are using this technology to process the data, not just to collect
But
data.
in the general sense, obviously we don't have incredibly detailed information. We've got a couple of pages on each area, so we have to kind of extrapolate from that. But it seemed to me that they're saying, well, they've got this great processing advantage in terms of information, retrieval, and organization. Is that the sort of strength that leads you to think that they've got a sustainable advantage in the future?
I would say not at all, but still.
So what is their strength? That's what because you're right that the manager is very bullish and actually is trying to persuade the other people at Whistler to tilt towards Asia. This is where the growth is going to come from. So what is their advantage?
They've also been in the region for a while, and they
But
know.
again, other firms have been there for a while too.
Yeah, that's why I mean the strength that kind of outweighs the others, the competition, would be the technology's expertise.
The technology.
Plus, they also, I mean, they do mention that they have expertise in credit products.
Credit products. Okay, that's real interesting. They got a lot of expertise in credit products. There's something in that presentation of the Asian manager that just dumbstruck me. In the discussion about their expertise in credit products and the sort of product offering that they're putting to the Asian market. Anybody recollect what was said? And marketing should have noticed this. Yes?
So many of their clients don't understand their methodology.
They don't understand the methodology, and they actually don't want the product. It says in the write-up somewhere, I wrote this down, that the clients are really after like some sort of absolute return product. Yeah, you want to comment on that?
Well, actually, we should always keep in mind that they operate in the environment where, at least for the last few years, investors were upset with the returns on the equity side. So they don't only compete with the other firms focusing on fixed income. They have also to compete with the equities, and that's where I think that's where the major action are going to take place. I mean, between these two areas where the most of the communication is going to take place.
But the person admits that they're not delivering what the market wants.
But it seems that the trends in the market are changing as we're talking about globalization. Larger players coming into the market, and there's this whole shift from small regional players towards globalization. As that happens, we also expect the trend or the character of investments that we're talking about or the phobia of the types of investments to go down. Therefore, over time, these products become more popular in the market.
I think that this could be your extrapolation of kind of the situation. Is it clear that that's what this manager actually believes?
That's a good question.
Yeah. You know, it's real clear to me that it's just kind of like dropped in there real subtly. Oh, you know, we do a good job on credit, but one of the concerns that I've got is that we're not really delivering what our clients want. They want absolute return product. Now, a big issue in this case, this is a fixed income manager, and this is an asset management strategy. Is there a reason to be 100% fixed income? Is that even a smart strategy? If you're going to be a global player, multiple products, there's almost no mention in the whole case about, well, what about equity? You talk about the fees going down in fixed income, yeah, but equity, you know, maybe it's a different story. A lot more that could be made. Yes.
But equity is not their expertise, so why would you go after equity?
Well, you could at least offer an index product.
Well, index was popular a few years back, but I mean, last year wasn't. I mean, I don't know why you would go after equity.
They don't have. Look,
I
totally agree that they don't have an expertise in equity. However, it seems like the sort of research that they do in fixed income, you know, it's firm-specific research, could carry over to equity, right? So the decision to do whether there's a probability a bond will be downgraded, to me is very similar to the decision whether we put the stock on the short list, the sell list. Yes?
And I mean, they can generate additional fees by partnering with an equity firm so that that equity firm can offer their clients fixed income products and vice versa.
Yeah, something like that. There's no mention of equity. Yes?
Just a few thoughts on that. I mean, they might have strong reasons to believe that most of their clients, the major clients they have, are their risk profiles are not suitable for equities. So they might have strong reasons to believe that most of their clients want the fixed income, but they need to make some fine tuning to their products to make sure they completely satisfy their requirements.
Right.
But they might be very committed to fixed income for this reason, because they think their clients really want fixed income, not equities.
But okay, the clients really want the fixed income, yet it says in the case that we're really not delivering what the market wants.
Actually, I have a different read on that. Actually,
Okay.
My read was it's not that what they didn't deliver what client want. Actually, is their evaluation criteria is different from what client is using.
Okay, that is different, but that's a serious problem also.
I guess what this manager is talking about is Asian investors more attachment to absolute return, which means they don't consider risk. They just want to see the number, and that could change in the future.
In that type of environment, do you want to be a government bond manager or credit manager? It seems like you have, if it's absolute returns, then you need to be in other stuff other than fixed income.
But he also talked about the fact that the Asian investor got spooked by the volatility equity market,
Mm-hmm.
so they, I guess, the investors' taste could change.
But the next paragraph goes on to talk about that the perception among the manager's perception is that their clients don't want high volatility instruments because they're really wary of those.
Right.
So are we saying that those are contradictory?
Well, it seems like there is a disconnect. I guess my reading of the case, there's a disconnect between kind of like what they're doing and what their clients want, either on what they're delivering product-wise, the way that the evaluation takes place. It seems like there's a a misreading, at least, of the marketplace itself. We don't get much information on it, but it's just enough to make me kind of worried. I forget the exact words in the case, but it's something like not matching what the client actually wants.
To me, that's marketing manager's job to educate the client that you should value.
Okay, it's interesting. So educate the client as to what they want, as opposed to marketing being a group that figures out what the client wants and makes sure that the product offering and the evaluation, stuff like that, matches what the client wants. Also, you kind of mentioned, it's interesting, you're mentioning marketing as a separate group, right? Whereas there's got to be some connection between marketing and all of these other areas. Okay, I need to move from Asia because we got lots to do. I guess there's other weaknesses here that I noted, like they have the lack of research staff, lack of staff in general, they mentioned. They mentioned things about the high transactions costs, lack of liquidity in the market are kind of things that they face, but other firms also face the same problem. Okay, let's go on to the next group, which is Europe. What's going on? Strengths, weaknesses?
Let's start basically the weakness. One of the main weaknesses is we're looking for 25% growth. We only see the European market growing at 4%. We can't just rely on the rising tide to get us there. So we need to step in and really use our credit mastery to enhance that and add value, whether that's increasing fees and developing new products.
I want to return to these words, credit mastery, when we go to quant. Okay?
The market right now is basically, I think it's at 68% government debt, and one of the areas we think we could probably grow into is some of the more corporates as it shifts away and ratings fall from the AA, A plus as it indicated. So we're looking at that as another way to potentially to grow the to get to that 25%.
What is their competitive advantage?
Our knowledge, and right now we have a model that we use that predicts, but it only looks at the historical data, and I think we realize that competitive advantage is going to go away because everybody else is
Okay, so they might have an advantage right now, but in the future, it's not clear they've got that advantage.
But we know that advantage is going away, and we're trying to develop better predictive models.
Right. And are you trying to do that in Europe, or is Quant trying to do that? What's the story? They do also mention lack of research and staff for Europe also. Right. Need more credit? Is it Europe that needs more credit analysts? In a number of groups? I think they said need a couple more people.
They basically say they're pretty light on the quantitative side, and we don't really have any, our models are pretty simple, and we need to develop those, so it's something that definitely has to be worked on.
That to me is disturbing. Simple models work in the past. In the future, these models, has anybody ever done any credit modeling? No? These models are very complex. Very complex. To do this correctly, basically you need to take, it's to evaluate the credit risk, you have to take the capital structure into account. There's all sorts of embedded options in that capital structure. It's highly quantitative and quite difficult to do. And they got a simple model that they're using right now that does not appear to be sustainable.
The good thing is they realize that.
Yeah, that is good. And what about the sort of branding, competitive position in Europe? We're not given much information on it. Do you have a sense of?
It seems that they're selling most of their products based on their credit expertise, and the clients are buying that currently. But that market is getting to be a little bit more competitive, and they they talk about with so many new credit disciples in Europe, it's going to be difficult to basically provide any value in the future. So it's going to be more other type of products that perhaps will.
How are they using track record?
Lima track record?
Their past performance is part of their marketing.
Yeah. But what past performance? Yeah.
Using US.
Using US. And I think there was some concern that European investors not that impressed with some sort of US benchmark. So there's an issue of benchmark. There's a lot of discussion of benchmark in this case. Is what the appropriate benchmark is.
I think what they were saying is that it actually was an impressive marketing tool in the past, but they're not necessarily moving forward.
Right. Because the US performance has been good. There's no doubt. Okay. The other thing I wrote down here was that they were small in size. So smaller in size than other parts of the world, it would seem. And there's a lot of, I guess, European competition. Indeed, this CUB might be European, right? Okay, Americas. We've got two groups doing Americas. Why don't we have one do the strengths and the other do the weaknesses? Strengths first?
Strengths is basically the statistical analysis.
Mm-hmm.
It's one of the strengths that
I want to come back to that when we do quant.
that we manage to identify. And they have a lot of experience and good research, which is useful in the structurally diverse US debt market.
Good research.
Yeah.
Okay.
They didn't have many other strengths, actually.
Their track record we already mentioned
Yeah,
is
they've
good.
got a good track record, offering about 100 basis points above the marketed return and the US aggregate index, and they've matched it.
Yeah, okay, let's talk about that a little bit. That somehow they figured out how the index construction works in such a way, I think it says somewhere that they get 60 basis points just from that. I forget the exact phrase, that just by nothing special about picking, but just kind of their management of the index, they can pick up 60 basis points in the past. How sustainable do you think that is?
Probably not very
I
sustainable.
think it would go away. You know, if you can get 60, somebody's going to figure that out pretty quickly. It's purely mechanical.
Standard mechanical approach.
Right. Weaknesses.
The main weakness that we see is that their strategy may not be sustainable because it's based on several approaches. One is credit spread,
Yes.
and they realize that their modeling is not really up to par to keep up, and more information is going to be released. More and more people are going to be aware of the same information at the same time, and therefore they won't have this advantage to be the first to be able to predict what's going to happen. Another problem.
So basically what you're saying, their strength is their weakness. So the strength is a past strength,
yes,
right? And really what we should be thinking about are the strengths that are sustainable into the future.
Yeah.
So in the past we've got this strength,
Yeah.
right? But it's going to disappear potentially.
Which is a threat due to the new transparency of central banks, the easy access to information. So it's being eroded very quickly.
Okay, continue with weaknesses.
They work a lot with the yield curve. They were unable to predict the new yield curve.
Yes.
They have an explanation regarding the inverted yield curve. We don't know if it's true or not. It makes them look good, but it may be another reason.
Yes.
They seem to rely a lot on the central bank for their forecast, and they think that the central bank is going to continue to intervene in the market to smooth the economy. So it can be good or not good, but it's difficult to make any forecast on that, I think.
Yes.
To add on to that, and maybe to build a bridge between the two, with the infiltration of technology in the industry, there's also a lot of new product line growth, which creates new types of indices, and with a globalization process on top of it, third generation and potentially fourth generation indices are appearing. For example, they're moving on to US universal indices, whereby there are more, or there's a reverse crowding out effect whereby government participation in the bond markets is decreasing, therefore making credit spreads a more prominent issue, which Pierre has already pointed out that we are not very good at predicting volatility or tilting of the yield curves. On top of that, being global, global aggregates are also becoming important, and with the coming up of Asia and Europe as important bond markets, we find that there's not enough data, historical data, to sufficiently put in the models to make reasonable predictions on yield curve spreads. So those are major weaknesses. So therefore, a potential solution could be to move away from active management and do some yield indexing, which Ray suggested earlier. Track the index and do minor enhancements.
So, okay, but anybody could do that. Right? It's like a commodity. There's no money in that.
Anybody can do it, but maybe nobody has done it yet. With new indices coming up, we can create new products, and with new products, we can meet more
So you think
varied client needs.
that's going to, at a very low fee, right? Because you're not doing anything but tracking the index. You know?
We're looking for volume here because fees are being under pressure.
For a pure index product, you know that the fee is the lowest.
Right.
Right? So, and the more it's performance kind of oriented, the higher the fees, going up to equity where it's the highest.
Right.
Yeah.
But as it is under our current portfolio strategies, we're already recommending maybe between 4 to 6 transactions per annum because of illiquidity in the different product groups, as well as a high varied transaction costs across different cross-section of products.
Right. So basically, you're suggesting a radical departure from their previous strategy, where it was kind of like based on more active management. Given that their models don't look very promising in the future,
right?
That maybe they need to abandon, go to indexing. Yes.
I would say that maybe a blend of the approaches could be best, because you could offer some type of enhanced index product which takes our strength from the past, at least, and active management, which the brand name and the fact that we do have a good track record is worth something, even if those models may not be worth something. And so that you say, you know, this is basically the same group that did this. We're offering you an enhanced index product that you might get higher fees than a straight index.
So just to be clear here, so you'd be tracking some sort of aggregate and then pasting on your alpha from maybe something else that you do really well. Okay? And it wouldn't necessarily have to be the same assets within the index. It could be something completely different. You paste on the alpha, and you've got kind of an enhanced index return. It's very highly correlated with the underlying index, but it's got an alpha pasted on. I guess the thing is, how much confidence do you have that they can generate that alpha? And where are they going to generate it? Like, what is their expertise here? It's mainly coming from the US. You guys should know, right? The performance that Europe is using is the US performance. So where's their real expertise? Yes?
Well, it mentioned they had a strength in duration positioning. I mean, they mentioned they were good at it.
Yeah. I guess they mentioned they were good at it in the past. To me, that it doesn't really mean that much. It doesn't suggest that in the future they can do this. Okay, well, it seems, yes, Peter.
What's useful with the enhanced indexing approach is that it skirts some of the problems that you come across when you expand your asset base so hugely. In terms of retaining and finding new people to manage such a huge asset base, it skirts that problem because you can use your technology and less people to do the work.
Yes.
And also then with the problem of scale ceilings when you have such a huge asset base. If you're doing less transactions per year, then you're going to have lower costs and the costs that you get from moving the market.
Mm-hmm.
So that's why it could potentially be a good strategy to have a look at.
It's a great strategy if you can deliver consistently positive alpha. Okay, so if you don't enhance that index, then you lose your business really quickly. Okay, so that's the risk. You have to have confidence that you can, even if it's a small alpha, like 40 basis points or 30 basis, if you can consistently deliver that, then you're going to look really good compared to just the pure indices. But if you don't think you've got that strength to deliver the alpha consistently, or if it's just too volatile, then it's not going to be a sustainable strategy. Okay, I want to jump to marketing, then back. Then I'm going to do quant. What do you think? You've chosen to enroll in this course probably because you're not doing marketing. All of a sudden, you have to evaluate marketing.
Well, we see our position in like being the bridge between our different offices and the consumer, our clients. But we don't see a whole lot of communication going on between the actual client and our factory, so to say. So I kept seeing the word consultants popping up, but there was no actually our boss, Mr. Scotty, he never really talked to our salespeople. So they should tell us what the customers really want from us. And there's no communication. That's the first weakness, basically, I would like to point out.
No communication,
yeah.
Number one. That's a devastating problem for a marketing function, right? Isn't that usually, is it the 3 C's or 4 M's? I forget.
Okay. Another weakness is definitely our, again, it deals also with the communication, is our internet. The content of our webpage probably is obsolete, apparently. We don't quite understand how we could have let this happen. We were wondering if this could be outsourced maybe to an independent company who would keep up our internet presence, so that we project an up-to-date image to the potential customers.
Was it the CIO or marketing that was arguing that IT should be elevated to a functional level?
It's quant.
It's quant? Okay, yeah, well, so we'll get to that.
Another thing we saw the weakness was basically that Scott pointed out that our product menu could become stale. Yeah, every product menu will become stale sooner or later, but it's part of marketing's responsibility not to let that happen, basically. Which again comes back to the communication.
So it basically, you could have phrased it, well, it could be that we're not going to do our job.
Exactly, that's basically the what you read between the lines.
Yeah. Now comment on kind of this issue of integration. You talked about communication with the salespeople. Mm-hmm. What about the communication across the different groups?
Right, and we have to bring these two people together, these two groups together.
Not just two groups, there's multiple
groups.
Well,
all of these groups, yeah. Basically, salespeople and the different regional offices to be able to offer a worldwide product.
We have to actually make sure we understand what our clients need. What our consultants who are going around to investment managers, giving them advice. What are they telling us? What their needs are, and we have to convey those to Asia and America and even the quant guys to look into it, to develop products around that, so that we can have a diverse array of products which we can go and offer to the clients.
Is it clear that Scotty's figured this out?
To some extent. He's been talking to clients, but I'm not sure.
That's different, right, than talking to the Asian manager.
Yeah, I'm not sure on the other side, within the company, he has conveyed that, hey guys, this is what market wants. You're barking at the wrong tree, going on yield curves when they're looking for credit products or currency products. It's something we need to have very constant communication, so that the whole company is working on satisfying.
Right. It's not just communication. It's not just taking the client out to dinner, right? It's actually having a process in place where you take the information from the client and you turn it into action. And I see no evidence that they've thought that through. It's like, let's chat with the client and maybe do something. Did you?
I was going to say that it seems like in the past they were pretty established in the U.S. and they have visions of potentially having good relations everywhere else in the world, but they haven't really done anything with it yet. They say a lot of, well, we need to do this in Asia, we need to do this in Europe, we need to get some alliances here and there, but it seems like they really haven't done anything yet. They just say, well, all these areas are weak, but if somebody should do this.
Right, a lot of talk. Yeah, and one thing that I want to throw out is whether you think this marketing person has a U.S.-centric view of marketing, whatever that means.
Yeah, just adding on the process that you mentioned, that also relates to the lack of, they know that the clients want the more diversified products, and they know that, it might be better to customize the indexes for different regions, but they haven't really worked with the rest of the with the rest of the group in order to know if they're actually able to provide those products, and if it's going to be better for the team to provide those products. And just another one has been also a weakness with dealing with the media and getting people to know what are the strengths of Dream Team.
Yeah, it's not just working with the media. Is there a media strategy? No.
It seems like his concept of other groups, especially the regional groups inside the company, tend to be more along the lines of, do I have enough staff people to cover myself there, and not what is our expertise in those particular regions. And so he's very, all I care about the regions is, do I have enough people there? It's not like he's focusing on the integration of the other groups in marketing.
Yeah, what about this idea that it's U.S.-centric? Like, there could be two marketing strategies. Why not have marketing completely self-sufficient in Asia? Why does it need to be centralized? So why can't we just have a marketing group in Asia and there's no communication with the marketing group in the Americas? Is that what we should do, or? Yeah.
I mean, I think there's cases where it can help if you have a specific marketing effort in Asia that knows the local situation, but there's potential for it to have conflicts or contradictory messages. If you do have global investors and they're looking across the globe, if the America's marketing group is saying one thing and Asia is doing another thing, I think that would be detrimental if it's not, synchronized.
Yeah, Jay.
I'd say something very similar. Basically, investors are getting more global, and if they're looking for credit products, they want to know your advice on where to go internationally, whether it's Asia, Europe, or the Americas, and they're going to rely on that advice. And you have to provide marketing products that direct them in that way.
Okay, that's good. Igor?
They also realize that the introduction of the global indices has resulted in significant growth and outreach and demand for this product. So it might help to have the international marketing.
Okay, so I think that kind of what we want here is like a global sort of function, but it really has to know the different functional areas and kind of interact, right? I assume this is what you're taught in your marketing courses, right?
As one of our group mates said, act locally, think globally.
Yes.
I think that's what we need to do in our marketing.
Yeah.
I think the ultimate answer to that question a lot would have to depend on who the customer is, in the sense of if you have a lot of isolated clients within Asia who are only making Asian decisions, as opposed to if you're saying, oh, we have global portfolio managers or investors who are making decisions for various regions.
Sure. No, totally agree. Yeah, it struck me that the marketing person probably isn't a marketing person. Has no idea of what's happening. I put my notes, marketing person has no clue, which is very disturbing, right? Because a lot of this can be marketing driven. Right? Part of the problem with marketing is it's not clear that they really have a strength to market. Well, what does Juan think about their we've kind of come down to one competitive strength that they've got some sort of technology that appears in the past, at least, to have delivered good returns. That track record is quite impressive.
Yeah, we actually didn't think that this was a real competitive advantage, because although we were using very sophisticated models, we didn't actually have any breakthrough. I mean, nothing really new. We didn't add anything. So we supposed that actually our competitors were basically using the same models They mentioned Arch, very, very sophisticated model like fractals, genetic algorithms. This is kind of interesting. But actually, they did not impact. They didn't bring anything new. So we are probably very good mathematicians and statisticians, but it doesn't seem like we are contributing very much to especially to the result of our portfolios. It was kind of interesting. The CIO called upon us. I mean, I was kind of reading that as a message to Juan. He was saying, well, it's very nice to have some academic exercises, but we want to see some results in our portfolio management as well.
Okay, so they talk about these techniques. They actually discard the neural nets, genetic algorithm, and whatever.
Wavelets.
But they're very excited about, what was it, wavelets? They're very excited about. Yeah, I kind of chuckled at that because that is not what you want to bet on.
We had no idea what they
Yeah,
were
I know.
Yeah, it was very nice to see that. Basically, she ended the paragraph saying, okay, all this classical, very sophisticated model didn't bring any good innovation,
right.
Period. And now we're looking at wavelets. You know, it's like adding another thing that might not.
So we've
bring
exhausted
anything
these
back.
other techniques. They don't work.
Right.
So we're going to move to something new. We have no evidence that it works. What about the whole? There are two things that struck me. One was that they want a push-button approach for all the allocation.
That was kind of scary.
Yeah. Well, I think that relates to there's clearly a contentious relationship between quant and the whole rest of the firm, where number one, she's willing to say that, like, get rid of all of you and just do it all automatically. And then she made some kind of derisive comment about the back of the envelope allocation that everyone ends up doing and disregarding all of the quantitative analysis.
Yeah. So I didn't really understand that. She wants to fully automate everything based upon the quant models, but it's not clear what the model is.
Not only that, but actually she's saying right after that all the parameters, basically the factors that they are using are going to be under discussion because of this globalization. I mean, currency factors are going to impact on how to read the yield and the duration factors. I mean, it seems like the scenario is really changing below their feet, even though these models might be good for us.
What about the credit modeling? They said something about that. Is that done within the quant group? I think that my impression in reading this, and maybe I was reading too much between the lines, is that they're actually using a service like KMV to do the sort of probability of default sort of stuff. So they're relying heavily upon other organizations to do some of their quant modeling, and then they kind of layer on some credit analysts. Yeah. So I couldn't tell what they were doing. Like I could see that, well, we need 4 more credit analysts. That somebody said that in one of the groups. But I really couldn't tell what they were doing that was adding value.
But at the same time, I think that she recognized some of their weaknesses, where she was saying that whatever model it is they're using is only as good as the data that gets input, and she wants to invest in information and compare internal models to external models to see what else is being used on the street.
And there was discussion of elevating IT to a functional area and stuff like that. It should have been done, anyways.
Right.
Like that's no big deal. It's not clear you're going to get a competitive advantage in actually doing that. And information is getting cheaper and cheaper and cheaper. So it's not clear this particular firm, if it goes that route, is going to have a competitive advantage. So a lot of the advantage we've been talking about in sort of the credit modeling, I don't know where it's coming from. Not coming from quant. Is it like some betting? Maybe. Maybe it's from economics. Economics. What about this function? Very interesting discussion.
There's an argument there, and actually we don't see much strength in econ. And basically, I think if there has to be one, it's their basic assessment of the new investment landscape. And given the assumption that the assessment leads those of similar asset management firms. Because the assessment is that the fact that new risks come with new information and a new credit channel. And based on such awareness and assessment, they recommend that the firm invest in information architecture to further automate the information collecting process and to further integrate outside information with internal processing.
But isn't this the sort of stuff that is just kind of like regular stuff that you just have to do day-to-day sort of stuff, right?
That's why I say we didn't see much strength in the but we do see some creativity on their part that they propose a leverage back fund.
Some creativity, okay, and that's why you gave them 5 rather than something else. Okay, so kind of my view so far is that they're kind of like saying the stuff that is going to keep them at the same level, maybe, but not anything that's going to elevate them, the overall firm. And economics impacts all of the groups, right? Now, I've got some creativity in suggesting a hedge fund. And indeed, this is complemented by a number of the groups, right? And I think the CIO even says something positive about this. Let's think about this, okay? We've got some economists in the economics group. Okay, how comfortable are you people in having the economics group run some sort of macro hedge fund?
Isn't that the way you want it to be? You want to have the economists run a macro hedge
Basically
fund?
what they're suggesting. They get some unique insights on the data, and a macro hedge fund, you just taking large bets. Think the yen is going to appreciate, so you take a massive position on that.
The level of risk may be completely incompatible with what we used to deal with.
Yeah, and there's multiple levels of risk, right? Not just their investments, but do these people have the expertise to run a hedge fund? To me, it's an extraordinary suggestion that the economics group is going to run some macro hedge fund. It comes from nowhere, and then these other people are saying, "Oh, that's a good idea." That doesn't make any sense to me. Yeah, it's true, it's creative, but it's just a bad idea. So, some higher power. One of the webcast students has taken over controls. Yeah.
So,
right.
I mean, when I heard of the economists running a macro hedge fund, it seemed like, well, you would want to have the economists providing some input into the fund, so that would seem to make sense. Is the argument then that, well, you wouldn't want the economists running a hedge fund because they don't know how to run a hedge fund, not necessarily that they don't know the inputs into the hedge fund? Because
yeah, they're not going to actually be executing the individual transactions, right? Somebody else is going to be doing that. But are you comfortable with the economics group, given what you read? Okay, and it was mainly talk. Are you confident that they're going to be able to figure out, well, we should take a massive long position on the yen?
I'm not sure if I'd feel comfortable, but from a marketing standpoint, I know that one of the emphases was that they want to somehow get absolute returns,
yes.
kind of like what was mentioned
Sure.
over in Asia. And a leveraged debt fund seems to be a proper way to do that, especially if they're a fixed income.
Yeah, I don't have a problem with a leveraged fund. I don't have a problem with a hedge fund. Okay, but coming from economics, and don't take this personally, that it seemed like out of the blue, not thought out well. No sort of extra information as to how it would actually operate, how they would do their forecasting. Are they really making the case? They've already said that they have no ability to call currencies, right? We've seen their performances degraded in credit. So what are they going to do in this hedge fund? And it seems like the initiative has come from economics. If they want to run some sort of enhanced sort of fund based upon some other strategy, okay, they've got some quantitative model or something that they do really special. But I just saw no basis for thinking that, it is a creative idea. I give you that. And it actually fits in well because it is higher fee. But it just like dropped in to this presentation. And it just, I would be very nervous about the economics group running it. Usually the economics group provides overall research that the other groups use. Okay? But for them to be running the hedge fund, that's a little bit of a stretch. Okay, yes?
To have in the same firm a product which is basically a global macro hedge fund and bond portfolios management, is it not spreading too thin? I mean, it's just, it seems completely incompatible.
Yeah, but they're going to go to 300B, so they need to do something. Hedge fund's not a bad idea. It's just I just don't see. I don't have a lot of confidence that they can pull it off. I don't see how they're going to add value in the hedge fund. And when it comes from economics, it just makes me nervous. Okay, it makes me even more nervous that other groups within the firms are saying, yeah, it's a great idea. Okay, without really thinking it through. Okay, we got to do CEO and CIO. Yes, John.
Sorry, I have a question. Can you clarify what the leftist debt funding actually? We have some debate on the management.
Yeah, it could mean many different things, but it could mean that let's say you can get an alpha, okay, based upon what you're doing in terms of your corporate bonds. Okay, what you basically do is you could double that alpha by leveraging. Okay, so you take double the number of assets, so half of it is borrowed. And you increase your alpha, you also increase your volatility as a result. So you leverage, and then this volatility is maybe something that a hedge fund investor would be okay in bearing, increased volatility. Okay, so that's basically what's going on. But a lot of this depends upon whether you can deliver the alpha. But nobody has really convinced me that this firm can deliver the alpha. Like nobody can really guarantee an alpha in the future, right? Because models change. But I just don't get any confidence that they can do it. CIO. What do you think of CIO?
Well, I'll start. I mean, we'll go ahead. He covered a lot of things, the CIO, but I think the main thing that stood out is the fact that he realizes that in order for the group to maintain their jobs, basically, they need to grow at the growth rates identified. And what I found lacking was applying some kind of reality check to that and be able to say if that was really the way that is that the kind of job security environment that this group wants to continue to work in, and potentially they should really focus on something else. Try to change the measurable parameters in which they're operating. Another thing, there seems to be a lot of emphasis on the baby boomers and where that and how that is going to contribute to their ability to increase their asset base. But there is some risk involved in that, and that is whether the assumption that the baby boomers will really be favoring that type of investments. If that doesn't turn out to be the case, then they're in a pretty precarious situation.
Yeah. I thought the CIO should have at least put on the table this idea of diversifying the product base into things other than fixed income. It wasn't on the table. Yeah, I was impressed with the CIO's vision, that there was actually a page or so where they're talking about, the CIO is the only person that showed like some vision of the future. And that was a useful discussion. Yeah.
I think the other thing the CIO is lacking, though, the CIO has a kind of a dual role. He needs to be a sanity check against the CEO's objectives for the firm, like we just talked about. He shows that vision, which is good, but what he doesn't do that well is create an umbrella for the other managers to kind of combine, coalesce, and condense everybody else's opinions and disparate strategies into a firm-wide strategy. And maybe that's something that's going to happen at the retreat itself. This is just pre-retreat memos, but he needs to at least...
Not his memo, right?
I'm sorry?
Well, he's got the benefit of interacting with all of these people.
Right, right. But even in this document, I think he needs to do a little bit better job combining everybody's, addressing everybody's concern to say, okay, we're going to look at a global strategy as to how we're going to move this firm forward. And I think that's the area he's lacking.
Okay.
And I think that's probably somewhat because nobody really understands yet how to meet the CEO's objective.
No, I was going to say, isn't that the CEO's job? I mean, it seems like the problem is that the CEO, I just reread, you reread, and the CEO just says, we want to be the best firm, we want to grow assets. There's absolutely no strategy from the top. And because of that, no one else below them really knows what to do.
Okay, but I think it's the number two's job to kind of like, what's the word, do some damage control here.
Exactly.
And it wasn't done. So obviously the CIO is not going to say, well, the CEO hasn't done a good job in specifying the questions, blah, blah, blah. But I agree that there's no, there's an opportunity for the CIO to go and say, let's kind of bring this all together, and the CIO doesn't do that. There's an opportunity for the CIO to say, well, I'm very critical of some of the points in functional area A and functional area B. But there's nothing like that. It's like they're singing praises of, fabulous Fred and marvelous somebody else, and there's no critique.
The closest he gets, I think, is being critical of the emergence of all these new indices that are coming out. Or at least he's skeptical about.
So what?
That's the closest.
That has nothing to do with your firm in a way. There's like too much discussion of indices in this case.
And he does point out, I mean, it says surprisingly for a people business, no one mentioned staff development and recruiting. And that's sort of a concrete action item that needs to be thought of organizationally, how the firm will grow.
I totally agree. It is an important ingredient, but you need to know what you're going to do. I have no idea what this firm's going to do. CEO. The CEO I left to last because she's been trashed, right? So, yeah, what's going on with the CEO?
It really seems like, especially from the memo and the lack of framework that she gave to her reports to generate any kinds of ideas or strategy or any kind of leadership that she's provided, there's a real hole there. She almost is like she's looking to them to give her the answers. And she's leaving things very wide open and very vague.
But that's okay. Like sometimes you don't really know the answers to the questions. Right, but we got to know the question.
Yeah, you have to have some kind of framework
right.
to get people thinking down a certain particular track, and she doesn't provide any of that. You know,
she provides lots of data.
Yeah.
Can you imagine a note from the CEO coming with 10 pages of spreadsheets? Everybody knows that data. They get that data every day. You know, it's like a note that goes around, and then all of a sudden you got 10 pages of spreadsheets that she's been working in the lounge in the Tokyo airport putting these spreadsheets together. It's a joke. You know, I read that, when I first read that, I just, what kind of case is this? Now, how can a note from the CEO come, and most of it, 90% of it is just like summary statistics as to how indices have done. So the CEO's asked the wrong questions. CEO knows nothing about strategy. That's real scary. Like, maybe I could understand somebody that's in charge of a functional area. Person in charge of Asia has kind of worked from the bottom up, been a great performer, and they put this person in charge of Asia, and they've not had really any kind of this top-down sort of experience, and haven't really thought about strategy. But it's the job of the CEO to pose the questions, to have kind of a framework to actually do something. The CEOs fail. One thing that also struck me as extraordinary in this case, where's CUB? He's nowhere. Like, don't you think it would be a reasonable idea for the CEO to maybe ask a representative from CUB to do some skiing at Whistler? There's no mention of CUB. Like, how can you develop a strategy when you don't know anything more than this 15% per year? But, it makes a big difference if that's like a 2-year period versus a 5-year period. What are they going to do? There's no sense of direction. There's no sense of the interaction between the owner and this asset management firm. The CEO is a disaster. Okay? CEO, has got to go. Yeah. So I guess when I look at our ratings that we did, just let me, in my last 2 minutes here, kind of summarize my read of this case. Asia, I would not give 7. I give nobody a 7 in this. Okay, maybe the highest grade I give is 5. Asia, it seemed like they were very confused as to what to do. I couldn't see anything going forward. No vision. Europe, no vision. I'd maybe give 4. America's, maybe I give the highest grade because at least the person was honest in thinking that, well, given this course, the only way we can do this is with acquisition. It doesn't make a lot of sense. Econ, I had only a one word, not a numerical, in my notes, fire. Marketing, gone. That's really, really bad. So marketing person's gone. The CIO, I thought did, you can be fooled by the CIO because you say, oh, this person's really visionary, right? This person's got vision. That's what we need with the CIO is vision. Well, yeah, there's some vision there, but vision alone is not a valuable commodity. You have to be able to put it all together, and you have to be able to clean up for a bad job that the CEO has done. And there's no evidence this person can do it. He's very eloquent, it's nicely written, but it's a disaster. And the CEO, you know, if this document was given to the people at CUB, she'd be looking for a new job. Okay, so I think that overall, this case is, I think, an interesting case because it tells us something about how to think about strategy, how to like take the stuff that you learn in a non-finance course and apply it to finance. And you're going to find that not a lot of people, if you go into asset management, have thought through the strategy up to the very highest levels. Indeed, as I said, when I did this case, there were people at very prominent firms that were very quiet when I was saying things like, the CEO is gone, because they weren't saying anything. Or the marketing group has no vision, because they were thinking this is their firm. Okay, so strategy is very important here. And even though this course is quantitatively oriented, all the assignments that you're doing, you need to have, if you're going to move to the top, you need to have the ability to actually put vision into action. Know what you want, figure out whether it makes sense in terms of value, and then design a strategy to actually get there. This firm is not going to win, in my opinion. Okay.
No, we don't need